Okay, good morning, everyone, and welcome to the investment meeting for July 2014. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, representing Police Commissioner Bratton.
Joe Alejandro, PBA. Chris McGrath, PBA.
Bob Ganley, SBA.
Lou Turco, LBA.
Chris Monahan, CEA.
Karen Paxtis, DEA.
Bob North, Actuary.
John Dorsey, Controller's Office.
Martin Gantz, Controller's Office.
Susanna Vickers, Controller's Office.
Carolyn Wilford from Mayor de Blasio, and I also have the proxy for the Finance Commissioner.
Bob Senskestead, Pension Fund.
Kevin Holleran, Pension Fund.
Nicole Jambrisi, Pension Fund.
Mark Jarvis, Controller's Office.
Okay, with that, we'll turn it over to Susanna.
Susanna, just 1 second before you begin. I just want to take a personal minute here. And, today's July 1st. For me, it's a significant day because I've been doing this now for 15 years as of today. But on a more personal note, and I know the person who I'm going to say this about is probably mortified, but nothing makes a man feel older than seeing his children grow before their eyes. And today is the 16th birthday of my youngest child, my daughter, Jenna. And she's becoming a beautiful young lady. And I just wanted to say, Dad's at work, as you can see, but happy birthday, I love you. So, thank you.
That's great.
Now I'm truly an old man.
Are you making her watch
Very
this
nice.
on her summer
Yes,
vacation?
I will. She will watch every one of these all summer.
That's what the tape was for.
There you go.
I hope that's not the only presentation.
With that,
Very nice.
Susanna?
Okay, well, thank you very much, Kevin. I think we'll have a quick meeting, but it's with a lot of good news that we have to bring you today. So just to remind everybody, Seema, our former CIO, yesterday was her last day. The new CIO, Scott Evans, starts on July 14th. So for this investment meeting, we will have someone interim to talk about the investment reports and to go through some, I think we can say, very preliminary year-end numbers, and that's Martin Gantz, who everybody knows.
Yes, so-
I'll turn it over to Martin to do the monthly.
Thank you, and Joe, happy birthday, and to everyone else, happy fiscal new year. I'm not going to go through all the economic charts. A lot of what you've heard from us in the past continues, and what you've been hearing in the news. There's a lot of sluggish economic growth concerns. Growth putters along at an annualized rate approximately at 2%, but evidently the market likes it. And so if you look at a couple of charts that we have here on page 5, unemployment rate is down to 6.3%, but unfortunately that 6.3%, which is a significant improvement, includes or doesn't include folks who have, according to the Labor Department, dropped out of the labor market, which is a problem for the economy as a whole. And you see that on the next page, on page 6, the consumer sentiment, which is stuck at not a very high number, 81, which historically is not a high number. But then you have other key points of information. So, for instance, turn to page 11. You see auto sales, that's 16.7. That means that's an annualized, and this is a 5-year chart. And so you see it's at a new high. If you go back to before the crisis, the 16.7, that's 16.7 million units of new autos sold in the U.S. on an annualized basis. That's very close to the all-time high that we had before the crisis. And no, these are not all because of GM recalls. These are actual new auto sales. On page 13, you see that CPI inflation at 2.1%. It's very tame, which has been always a concern given the balance sheet of $4 trillion of the Fed. I want to also turn to page 18, the VIX, volatility. And I'm going to get to the market in a moment, but this leads to that. This is prepared last week, as you know, so the number is 11.18. The VIX number is not much different from what it is now. This is a measure of volatility, and this is an extraordinarily low number. It just doesn't go much lower than this, and you've seen that in the market results over the last couple of months, pretty much May and June, where it's been slow and steady new record highs, a little bit up, a little bit up, a little bit up, a down day, then a little bit up, and new record highs. And there's very little volatility in the market. 10-year treasuries on page 20. We show here at 2.6. In the last week, it's down to 2.5. So even with the Fed tapering, and we expect the tapering to be over their original $85 billion a month purchase of treasuries and mortgages, should end by October, November. But even with that, you have low interest rates. And on the page after that, on page 21, where you see high yield spreads in red and investment grade spreads in blue, you see spreads continuing to come down. So rates coming down, bond prices go up, spreads coming down and compressing, bond prices go up even more. That's why bond prices have done well, as you'll see a little bit later. The last number on the investment grade spread, which is important, is 98. What that means is, on average, for the investment grade universe, as of the date of this, which is actually almost a month ago, it's lower yet. It's below triple digits. It's 98 basis points above treasuries. So corporations are able to either refinance or issue new debt at extraordinarily low rates, and it's now almost near the lows that we saw in 04 and 05 and 06, which is great for corporations to refinance. How did the pension fund do, or how did the market do, and we'll get to the pension fund later, how did the market do in May? So if you turn to page 27, we put this in much larger print because I'm getting a little older and can't see the small print. The first section is the U.S. equity. Russell 3000, you see, returned over 2%. 2 columns over, fiscal year to date, 11 months in, 22%. I can tell you in June, as of yesterday, which was the end of June, the return was 2.5% for the month of June, which means it's even higher. So May was good, June was good. In fact, you will not see a negative number for any asset class in May, and a similar aspect that you'll see in June. For EFA, developed markets, the return was 1.6%, also bringing the fiscal year date return to 22%. June was just shy of 1%. Emerging markets continued its rebound up almost 3.5%, bringing its return to over 11. June was 2.7%. Core plus 5 in the month of May went up 1.44%. That's towards the bottom. That's because interest rates went down, as I just described, in May. That brought the return to a positive 5.4%. June was slightly positive by about 10 basis points. Interest rates were roughly flat. Next page, high yield was up nearly 1%, bringing the fiscal year date over 10%. June was up another 70 basis points. Bank loans up, TIPS up 2%, again up in June. Convertible bonds up 2% in May, another 2% in June. Even REITs were up. Everything was up. Put it all together on the next page, page 29. If you take a look at the bar chart on the left, the 1-month return for May was 1.87, and the largest contributor, as you see, is in green, which is U.S. equity. But everyone was a positive contributor because every asset class had a positive rate of return. In the middle, you see the fiscal year date return, which is the 11-month return, which is 15.75, and I'll show you what that means in market value in a moment. Where are we allocated right now on page 30? Similar to where we've been before. You'll see on the left, we're in green, overweight U.S. equity, and in the middle in blue, underweight core fixed income and TIPS. The core fixed income and TIPS are slightly beyond the rebalancing range. We have not, we did not put more money in there because we know we have some pending real estate deals and opportunistic deals, and these are parking places. So once that money goes out in real estate and opportunistic fixed income, the underweight goes away because the parking places go away. So it will take care of itself. Market values, page 35. This is a remarkable year. You see just 2 pretty much down months for the 11-month period. After May, the lease was up to almost $5 billion. June was another good month, and I can tell you the estimate that I have for June would be similar to what we have for May, maybe a little bit less. So for, just got the number here, we had high ones for 1.8% for May, probably a similar return, maybe a little bit less for June, which would probably bring your return in the 17% range. This is unofficial. We do not have returns from private markets or from our custodian, but that's remarkable. And the market value, which at the end of May was up to that 33.4, would be just shy of 34 billion. So if you see where the fiscal year started at 28.9, we're probably close to 33.9, which means you added $4 billion even for the fiscal year. The next page, on page 36, shows the 10-year trend of market values, and each point is the fiscal year end. The arrow is the return, the 10-year return as of May is 771, and that, as I mentioned, does not include the increase that we know we're going to see in June, which we'll report to you at the next investment meeting. This is all good news. The next section would show you the results for each of the sectors and the individual managers, as well as private equity and real estate market values and cash flows. So are there any questions?
Great work, Martin, and all the investment staff at BAM. The market values. I neglected to call in our consultant, Barry Dennis, who's not here today. He's out of town and wanted to call in. So maybe before we go on to the next agenda item, we'll connect him. Do you have the 650 number?
John, I'll have you know if we have any items with whereases. I brought my constitution today, so we could talk about that.
In honor of July 4th.
July 4th.
You guys really started late.
It beats getting on a plane and coming.
This is true.
Morning.
Good morning, Barry.
Good morning.
We're on. We're ready to go.
We're actually, we've already started, we just went through the monthly reports with Martin, and it's
Great.
pretty good news.
Yes, it is.
Yes. So thank you for joining us. The next item, I just wanted to sort of close the loop on the basket clause. Guess I don't have to yell. So everybody knows the basket clause legislation, a compromise level passed Albany this session. We're anticipating the governor's signature. We got an increase to 30%, not 35%. But we still think that it'll give us a lot more flexibility and ability to, be more tactical and strategic to create these amazing risk-adjusted returns that we seem to
Well,
want to deliver.
Barry, will you be able to, I guess, in anticipation of it going up to 30%, start working out various scenarios for the trustees so that when it does happen, we can start discussing issues with, asset classes and what we intend to invest in or what needs to be changed?
Certainly, Joe.
Yeah, and hopefully we can do that in conjunction with the new CIO, these.
Yeah, no,
were-
it's
yeah.
absolutely, it's all with the idea that, when the new CIO comes in 2 weeks, Barry will start obviously getting everything together to run those optimizations and,
Right,
but at least to start looking at it so that when we have our next meeting, I guess in September, that at least we'll be able to start discussing what we need to change or what need, if anything, and maybe what asset classes we'd like to maybe invest in or just adjust.
right, absolutely, that's on the to-do list, thank you for mentioning it.
And by the way, I just want to point out that, as you said, it was good news for the fund. You know, the performance, Bob North was shaking his head in the negative. He's never happy with any of the fund's
Oh,
performance.
no, I didn't see that.
It's good, just keep it up.
See, there you go.
We will try. So, yes, so the basket closet's all good news. Thank you, everybody, for your help. Anybody who wrote a letter of support or made a call on behalf of the bill, we appreciate it. Any other thoughts on the basket or anything else before we move into executive session?
No, so I make a motion that we go into executive session for the purposes of discussing investments or changes to the portfolio.
Second.
Okay, let's take 5 minutes, break down the